Welcome to today's deep dive. We're getting into something really fascinating today, something that honestly affects pretty much everyone.
Yeah, it absolutely does. It's one of those topics that completely changes how you view your own decisions once you understand it.
Exactly. So our mission today is to uncover the hidden, the often psychological costs of success, particularly when we're talking about wealth and business.
Right, because we tend to just see the shiny end result and completely miss what it actually took to get there behind the scenes.
And we're pulling from a really great source document today. It's an excerpt titled 14-nothingsfree.pdf.
Which is actually a little funny because if you read the text, it starts with a chapter header that says 15 point, nothing's free.
Yeah, exactly. A little numbering quirk there. But there's this foundational quote right on the first image in the source that completely sets the stage for us.
Oh, I love that quote.
It's so good. It says, everything has a price, but not all prices appear on labels.
That is just such a powerful, profound idea.
It really is. And today we are going to unpack exactly what that means. We're going to look at some massive corporate disasters.
Some really spectacular failures.
Yeah, truly. And we'll talk about the hidden currency of long-term investing. And then we'll get into a crucial mindset shift involving Disneyland, of all places.
Which I know sounds crazy, but it can literally save your retirement portfolio.
So if you're listening to this right now, I want you to just take a second and think about a goal you currently have. Whether that's buying a house or getting a huge promotion or just trying to build wealth.
Just hold that specific goal in your mind.
Right. And ask yourself, do you truly know the price of that goal? Or do you only have the sticker price?
Because most people only know the sticker price, and that illusion is incredibly dangerous.
It is. So let's start in the corporate arena. I want to take us back to the year 2004 and look at General Electric, GE.
Oh man, GE in 2004, they were the ultimate titan of industry.
Right. I mean, they were the largest company in the entire world,
Yeah.
worth $1/3 trillion.
You couldn't find a safer, more respected bet in the business world at that time. They were the gold standard.
Exactly. They were this shining example of corporate aristocracy. But then, as we all know, the 2008 financial crisis hits.
And that's when the facade completely crumbles.
It really does. And it crumbles because of a specific division that most everyday people didn't even fully realize GE had.
Yeah, GE Capital.
Right, their financing division. GE Capital was supplying over half of their entire profits.
Which is wild for a company most people associated with, light bulbs and jet engines.
Yeah, you think of them making MRI machines and turbines, but actually the 2008 crisis just destroyed their financing division.
Because when the credit markets froze, that massive hidden profit engine just seized up entirely.
And the bleeding didn't even stop there. They made these disastrous oil and energy bets shortly after, right before energy collapsed.
It was just one catastrophic hit after another.
So the end result is that their stock plunges from $40 a share in 2007 all the way down to just $7 a share by 2018.
A completely staggering evaporation of wealth.
Which brings us to the target of the blame. Enter Jeff Immelt.
Right. He was the CEO from 2001 to 2017.
And he just took an absolute beating in the press. He took the immediate, harsh blame for everything that went wrong.
And to be fair, a lot of that criticism is justified.
Exactly. I mean, I look at that and I think, well, yeah, if you're rewarded with dynastic wealth when times are good, you absolutely have to carry the burden when the tide goes out.
You can't just take all the upside and then dodge accountability for the downside. The buck stops with the CEO.
But here is where it gets really interesting.
Yeah.
Because Immelt had these parting words for his successor that are they're haunting.
Yeah, he said, every job looks easy when you're not the one doing it.
Every job looks easy when you're not the one doing it.
There is such a profound truth to that, because from the outside, the crowd criticizing him just sees the stock going down and thinks, well, just make better decisions.
Right, like, oh, just pivot to software or stop making bad oil bets. Easy.
Exactly. But they don't see the invisible challenges of actually standing in the arena.
Right. What kind of invisible challenges are we talking about here?
Well, Immelt was dealing with insane corporate bloat, short-term Wall Street investors screaming at him for quarterly growth, regulators, unions.
Massive entrenched bureaucracy.
Yeah, all of these conflicting, impossible forces pulling him in every direction, and none of that is visible to the people sitting in the cheap seats.
And you know what the grim irony of all this is? It proves his point perfectly. because his successor, the guy who came in to easily fix all of Immelt's quote-unquote obvious mistakes,
Yeah.
he only lasted 14 months.
Wow. 14 months. That just goes to show you the job was so much harder than it looked on paper.
Exactly. But this overconfidence, this belief that something is easier than it looks, it doesn't just apply to running huge megacorporations.
Not at all. It's an everywhere problem.
It's the exact same flaw that bankrupts everyday people who are just trying to grow their wealth.
Right, because we look at investing, and from the outside, it looks incredibly simple.
It really does. So let's pivot to the stock market, because the source gives us this staggering statistic. The S&P 500 increased 119-fold in the 50 years ending in 2018.
119-fold. That's just astronomical.
Okay, let's unpack this, because the common advice you hear is just hold stocks for the long run.
Right, just buy an index and wait.
It sounds incredibly easy. You just sit back, do nothing, and let your money compound. What could be simpler?
It sounds simple, but just like Immelt's job, investing only looks easy from the outside.
So what's the catch? Because getting 119 times your money doesn't come free.
Exactly. The reward demands a price. But the trap is that the price is not paid in dollars and cents.
Wait, if the price isn't money, what is it?
The true currency of investing success is volatility, fear, doubt, uncertainty, and regret. That is what you are actually paying.
Man, regret is such a heavy one.
It's the worst one. It's that constant voice in your head telling you that you did the wrong thing yesterday.
Right. And there is a brilliant analogy from the source text that perfectly illustrates this. Imagine you want a brand new $30,000 car.
Okay.
You basically have three choices. Choice 1, you just pay the $30,000.
You pay the sticker price.
Choice 2, you find a cheaper used car you compromise.
Right.
Or choice 3, you steal it.
Which is obviously a terrible idea.
Right. 99% of people know stealing a physical car is a terrible idea.
Yeah.
The consequences totally outweigh the upside.
You'd end up in jail. The physical world makes the price very clear.
Exactly. So apply this to your retirement goal. Let's say your goal is a steady 11% annual return for 30 years.
A great goal.
Imagine that return is that shiny new car. Does this reward come free?
Absolutely not.
No, but because human nature is what it is, we are constantly tempted to try to steal it.
We want the 11% return without paying the currency of fear and volatility. We want to commit grand theft auto on the stock market.
Exactly. We try to grab the upside and dodge the psychological bill.
And the reason we do that is because paying that psychological bill is genuinely agonizing.
It is. Let's really visualize this agony for a second. If we look at the second image provided in the source, the Dow Jones Industrial Average chart from 1950 to 2019.
What's fascinating here is that at first glance, the chart looks great.
Yeah, it's just this upward trending black line. It represents roughly an 11% annual return.
It looks so smooth and peaceful. But behind that black line is this dense, dark forest of gray shaded lines.
And what do those gray lines represent?
Every single time the market was at least 5% below its previous all-time high.
Wait, at least 5% below.
Yes, and if you look at the chart, it is absolutely dominated by gray.
It's almost entirely gray.
Exactly, which means that for the vast majority of that 70-year period, you were living in a state of drawdown. You were down from your peak.
That is insane. So the market is just this never-ending taunt.
It is. It gives you these big returns, makes you feel rich, and then takes them away just as fast, leaving you in that gray zone.
Let's bring in some extreme micro examples to make this hit even closer to home. Let's talk about Netflix.
Oh, Netflix is the perfect example of this.
Right. From 2002 to 2018, Netflix returned over 35,000%.
Which is just, it's lottery ticket wealth.
It is. But during that exact same incredible run, the stock traded below its all-time high on 94% of days.
94%.
Yes, and Monster Beverage is even crazier. Monster returned an unfathomable 319,000% from 1995 to 2018.
319,000%.
Yeah, but it spent 95% of that time below its previous high.
That is just, I mean, mentally, that's torturous.
Right, so imagine you are holding that stock. You've picked this generationally wealthy winner. But 95 out of 100 days you check your account, you see a red number compared to your peak.
You feel like you're bleeding.
You feel like you're actively losing money. How is a normal human mind supposed to cope with that constant feeling of loss?
Honestly, most people can't. They just can't cope.
Which is why they try to steal the car.
Exactly. Because they can't handle the volatility, they employ what we call tactical avoidance, so they try to outsmart the system.
Right. They try to get the massive returns without paying the emotional price.
They trade in and out. They try to sell to cash right before a recession and then buy back in right before the boom.
Sounds like a smart plan, right? If you can actually do it.
If you can do it. But let's look at the hard data on how that actually works out.
Let's do it. We have this Morningstar study on tactical mutual funds. And these are funds specifically designed to do exactly this: switch between stocks and bonds to avoid downside risk.
Right. These are the professional car thieves. Highly paid experts whose entire job is to dodge the gray areas on the chart.
So Morningstar looks at them during mid-2010 to late 2011.
Which is a really important time frame.
Why is that?
Because the S&P 500 dropped over 20% on double-dip recession fears. It was a terrifying market.
So this is the exact environment where these tactical funds are supposed to prove they work.
This was their moment. This is what they charge high fees for.
Okay, so out of 112 tactical funds, guess how many had better risk-adjusted returns than just a simple, boring 60-40 leave-alone index fund?
It's almost hard to believe. Only 9.
9
Mm.
out of 112.
Less than 10%.
It's wild. And Morningstar's conclusion is just devastating. They found that these tactical funds gained less, they were more volatile, or they had just as much downside risk.
The money gods punished them. They tried to seek the reward without paying the price, and they got hit with the worst of both worlds.
And it's not just the professionals doing this. Everyday people do this too. The data shows that everyday investors underperform the very funds they invest in by about 0.5% a year.
Just think about how crazy that is. You own a fund that makes 8%, but you only make 7.5%. How?
Because you buy and sell.
Huh.
You get scared, you pull your money out, the market goes up, and you buy back in at a higher price.
It's the bitter irony of investing. By trying to avoid the price, you end up paying double.
You pay in lost returns, and you pay in stress.
Yep.
So if individual investors fail at this, and professional mutual funds fail at this, what happens when a massive corporation tries to magically erase volatility?
Well, this loops our narrative perfectly back to General Electric.
Let's go back to GE, but specifically the era of former CEO Jack Welch.
Jack Welch. He was the grandmaster of this.
He really was. He was famous for perfectly beating Wall Street estimates. Like, if Wall Street expected 25 cents a share in earnings, Welch delivered 26 cents.
Every single time.
Yeah.
Regardless of reality.
Right. And reality in manufacturing is bumpy. But his numbers were perfectly smooth. How did he do that?
He did it by heavily massaging the numbers. I mean, they were pulling future gains into current quarters just to hide any weakness.
There was this famous Forbes report that dug into this, right?
Yeah, the report detailed how GE would literally sell locomotives to unnamed financial partners.
Wait, not to railroad companies.
No, to financial partners, just to shift the risks off their books for the quarter, but they'd still claim the revenue to make their earnings look perfect.
That is just blatant financial engineering.
It is, and the craziest part is that Welch was totally unapologetic about it. He practically bragged about it.
In his book, Straight from the Gut, right?
Yes. He wrote this unabashed admission describing how his managers would magically find $10 million, $20 million, and even $30 million after the books closed to cover an earnings gap.
$30 million just suddenly found after the quarter ends.
Just to maintain the illusion of smoothness.
So what does this all mean? Like, what's the real impact of doing that?
Well, under Welch, the stockholders got an illusion. They got exactly what they thought they wanted.
Right, a stock that just surged predictably. They didn't have to pay the price of uncertainty.
But the bill always comes due. You can't fake reality forever.
And when it came due, it was brutal. The penny gains of Welch's era literally became the dime losses of today. It set up that mammoth decade of losses under Jeff Immelt.
Immelt inherited a hollowed-out company because Welch spent years borrowing from the future to make the present look smooth.
It's not just GE either. Think about Freddie Mac and Fannie Mae in the early 2000s.
Oh, that's another perfect parallel.
They were caught doing the exact same thing, but in reverse. They were underreporting current earnings, hiding money, just to save it for the future.
All to maintain that exact same illusion of smoothness.
It's crazy. So this brings us to the core psychological question of the entire source text.
Which is really the crux of everything we're talking about today.
Why are we perfectly fine paying the explicit price for things like cars, houses, food, and vacations?
But we refuse to pay the price for good investment returns.
Exactly. Why do we fight it so hard?
Because the price tag isn't visible.
What do you mean by that?
Well, when you buy a car, you hand over $30,000. It's a clear exchange of value. But when your wealth drops 20% in the market, it doesn't feel like you're paying a fee for a service.
It feels like a fine.
Yes, it feels like a fine for doing something wrong.
If we connect this to the bigger picture, think about how human psychology treats fines.
Like traffic tickets.
Exactly. A speeding ticket or an IRS penalty,
Yeah.
those mean you messed up. You broke a rule.
And you were supposed to avoid fines. Society trains us to avoid them.
Right. So when your portfolio suddenly drops, your brain treats it exactly like a fine.
It tells you, hey, you did something wrong, you're being punished. Flee immediately to avoid further punishment.
So you sell. You lock in the loss.
Exactly, which is why you have to completely change your mindset. And the text gives us the ultimate way to do this. The Disneyland ticket.
I love the Disneyland analogy. Okay, so think about a Disneyland ticket. It costs, let's say, $100.
And over 18 million people pay that yearly.
18 million people. Why?
Fair.
Because you get an awesome day with your kids. You get the magic.
But the key is, out of those 18 million people, no one views that $100 as a punishment.
Right. You don't walk up to the gate and say, oh man, the Disney police are fining me $100 today.
No, it's a fee for admission. You happily pay it for the experience.
And this applies directly to your life and your investments. Volatility is not a fine.
It is the absolute cost of admission to get returns that are greater than safe, low-fee options.
Right. Because you aren't forced to go to Disneyland. You have options.
You can go to the local $10 county fair.
Exactly. In investing, that $10 fare is cash and bonds. You'll have an okay time. It's safe.
But if you want the magic, if you want the long-term compounding growth, you have to pay the $100 fee of volatility.
You have to accept the 20% drops as the ticket price. But there is a really important caveat from the source we need to mention.
Right. There is no ironclad guarantee that it will always be worth it.
Because sometimes it rains at Disneyland.
Exactly. You can pay the fee and still get a bad day.
But, and this is the vital part, if you view that admission fee as a fine, you will never, ever enjoy the magic. You'll just run out of the park.
You'll panic at the first sign of rain and leave.
Wow. Okay, we have covered so much ground today. Let's do a quick summary of the journey.
It's been a ride.
We started with GE's collapse, looking at how hidden challenges and artificial smoothness destroyed a titan.
Proving that no job is as easy as it looks.
Then we looked at the agonizing visual reality of the Dow Jones and how achieving massive returns requires spending most of your time in a drawdown.
The never-ending taunt of the market.
Exactly. And finally, we unpacked the critical mindset shift. You have to stop viewing volatility as a fine and start viewing it as a fee.
It's the only way to survive the game.
It really is. Now, I know you wanted to leave the listener with a final provocative thought to mull over today.
I do, because we've talked entirely about money and corporate success today. But I want you to apply this fee versus fine framework to your relationships.
Oh, that's an interesting pivot.
Think about the friction, the disagreements, the hard compromises you make with a partner or a close friend.
The messy stuff.
Right. Are you viewing those moments of relational volatility as a fine? Like as a sign that the relationship is broken and you did something wrong?
That's how a lot of people view arguments.
Exactly. But what if you started viewing them as the necessary fee of admission for a lifetime of deep, meaningful connection?
Wow.
Find the price of what you want in life, whether it's wealth or love, and ask yourself if you are truly willing to pay it.
That is just brilliant. Thank you so much for joining us on this deep dive. And to our listener, keep looking for those hidden price tags in your own life. We'll see you next time.